Just for purposes of, since we're coming out of executive session, just note for the record that the commission did not take any reportable action while in executive session. Any action that did occur while in executive session pursuant to SC Code annotated 9-16-80 and 9-16-320 will be publicized, when doing so would not jeopardize the commission's ability to achieve its investment objectives or implement a portion of the annual investment plan. And Mr. Chairman, that being said, the next item on the agenda is a presentation from our partners with Bridgewater, which I'm sure will, as always, will be a uplifting and paint an uplifting and rosy picture for the future. So,
thank you. Good morning, everybody.
Good morning. Alan Bowser is our principal relationship that manages all of the resources that Bridgewater brings to bear in support of our efforts, for which we're grateful. And Alan, I'll ask you to introduce Paul.
I will do that. And I've already been warned by the chairman that you shoot bearers of bad news, so I'm going to try to bring the sunshine, and then Paul's on his own. How's that for collegiality? First, I just want to really say thanks for having us here. You guys have been gracious in inviting us in many times to your retreats and other meetings, and we really appreciate the chance to be a partner with you. Most of you know us well, but just for those who may be a little less familiar, we're an institutional asset management firm out of Westport, Connecticut, and we've been described in many ways, but I like to think of it in very simple terms. We've basically spent the last 40 years doing three things. One is trying to develop a deeper and deeper understanding of markets, and the other is then trying to take that understanding and apply it in two ways. First, to be a good partner in delivering the best returns we can for the benefit of your portfolio and your beneficiaries. But the second probably has even more overarching value, which is to try to be a thought partner and help you think through some of the most important issues and challenges that you're facing. And that's really a lot of what we hope to cover with you today. I'm especially glad that Paul is the one who was able to join me. Paul, as a senior portfolio strategist at Bridgewater, works directly with our chief investment officers. But it was Paul who came and spoke with this commission, some of you may remember, in 2006, when you guys were really just starting on the journey of transforming the South Carolina portfolio from what it used to be, predominantly a stock and bond portfolio, to the more diversified portfolio it is today. And as part of doing that, I hope I can get this clicker right, you guys asked us to be a partner, and you asked us to help with that goal at the very top, which is to deliver high and consistent returns in two ways for you. One, from our best strategic portfolio, all weather, and then secondly, from our best tactical trading portfolio, Pure Alpha. And at the bottom, I put the cone charts that are familiar to all of you. Our expectation for these return streams, in fact, any return streams, is that you'll have performance in a range. And our expectation for all weather and Pure Alpha is you'll get a return stream that goes up and to the right, and it'll be within a range that we can set out and lay an expectation and an understanding with you guys. And basically what these cone charts show is that we've essentially delivered on those expectations in the roughly 10 years that we've been managing money for you. And in fact, since 2007, South Carolina has earned $585 million net of fees from these two portfolios. We'd like to continue not only this part of our partnership, but the thought partnership.
This conference has reached the duration limit for 3 or fewer participants.
And so in conclusion,
Please press any key now.
and we'd like to continue on that path with you. And in that regard, I'm going to bring up Paul to talk about the things that are on your mind today. Thanks.
This is good. The shades are down, so there can't be any sunshine here. So we're all set in terms of the first regards. I'm going to first reiterate just what Alan said. Thanks for having us here. We've been having a dialogue over the years through probably some of the most challenging investment period really since the 1930s. And today I want to share with you a little bit about what we're seeing in the world and then describe, consistent with the conversations we've had over the years, based on what we know today, what we would do in your shoes. And I have a few pictures to illustrate that, but then, as always, just interrupt me with questions. Let's just make this a dialogue. My goal today is really to make this as useful as possible for you. If you think about what's been going on more recently, since we began talking in 2006, 2007, you guys started working with us directly. We've been in an environment where, despite massive amounts of stimulation on the part of central banks, you've gotten relatively tepid but positive growth, very low inflation, and I think going forward, rather challenging returns from assets. If you want to look at a precedent for what this environment is like, I'd say it's probably most like what you saw in the 1930s. So people have had to contend with this before. We just haven't had to contend with this in our investment lifetime. I got up early this morning and took a chance to go for a run down to some of my old haunts. And I went down and I saw the damage that had been done at the canal when you got these intense floods. And that's sort of the environmental equivalent of what you've been living through in financial and economic terms. And then it's just a question of what the most reasonable path is forward from here for the Commission to be able to meet its goals. Primarily driven by low cash rates, which are primarily driven by central banks trying to deal with the after effects of the credit crash. All investors are going to face, from our perspective, a significant savings challenge going forward. The question then is, in terms of your strategic asset allocation and then your tactical shifts that you put on top of the portfolio, how to best use those two levers to make the best of what's objectively going to be a very, very challenging situation for pension funds, for insurance companies, for banks, for anybody that has a required rate of return in this environment. I'll describe the environment, then I'll look a little bit at your portfolio. Our best advice for you is to further diversify your asset allocation and make the best out of the tactical shifts that you can put on top of your portfolio. In terms of how we got here, spending always and everywhere is driven by just two drivers: income and borrowing. How much you earn, and you're borrowing against future income that you will have. One of the reasons why the U.S. economy and most developed world economies were so strong for so long is that while they had okay income growth, they had a self-reinforcing expansion of credit, really from World War II all the way up to 2008, which is what this chart is illustrating here, this massive rise here in debt. At a certain point, though, that begins to create risks for the economy, which came to bear in 2008 because basically borrowing is just a claim on future income, and at some point you got to pay it back. And if everybody in the private sector, more or less, is levered up, and everybody decides to reduce income to be able to pay back debt at the same time, you could enter a self-reinforcing collapse. And very mechanically, that's what creates depression. And that's what happened in the 1930s. You can see this chart back to then. And that's what happened in 2008. Typically, the way a central bank will try to get you out of a period of economic weakness, of course, is by lowering interest rates. And this black line here is showing you the short-term interest rates of the Federal Reserve going all the way back to World War I. And you can see here, I think this is a pointer here, them dropping it to zero in 2008. Almost any other time, if I said to you that the central bank was giving money away for free, you would expect that people would be borrowing it. But they didn't borrow it. And they didn't borrow it because the private sector, in aggregate, had too much debt already. And if the central bank lowers the interest rate to zero and you don't get a response in terms of borrowing from the private sector, you've got a real problem. Go back to that same framework. Spending is income plus borrowing. And if both those pieces are collapsing at the same time, the economy is going to be weakening a lot and asset prices are going to weaken a lot. The central bank at that point faced a choice. Either tolerate a depression, repeat the mistakes of the 1930s, or print. And you can see what they did here is they engaged this massive expansion of printing. Unprecedented, really, to anything that had happened in 100 years. There's good news from that, and there's bad news. The good news from that is it really helped stabilize the U.S. economy. While controversial, it helped stabilize the U.S. economy. Unemployment was 10%, now it's below 5%. You can compare that outcome to what happened in Europe, where they were much more reluctant to engage in the same policy as the Fed, and the results speak for themselves. You still have very high unemployment there and inflation way below what you have in the U.S. While the Fed solved one problem, avoiding a deflationary depression, they created another, and that's the one that you find yourself living with today, which is that all assets that this commission can invest in, stocks or bonds, emerging market or developed, illiquid or liquid, they all price relative to that cash rate that's there. And once it drops to zero, all of your returns are brought down as well. Initially, that wasn't so evident because the first wave of this printing of money actually drove assets up, and they, in aggregate, had an extraordinarily high return relative to cash, particularly equity or equity-like instruments. And you can see that described a little bit in this diagram here, which is, this is just how assets price. The Fed sets the rate on cash. Bonds mechanically price to cash rates. If you think about a 10-year bond, it's just a stream of forward short rates of what the Fed is going to do over the next 10 years. And stocks price relative to bonds, and then everything out here further on the risk curve, private equity, et cetera, all prices relative to these assets. Typically, what you see is this slide is upwardly sloped, i.e. a 30-year bond yields more than a 10-year bond, 10-year bond yields more than the cash rate, and stocks have a higher yield than bonds. In 2008, when this line dropped to zero, initially you saw a very steep slope of this dotted line, which essentially means that people were scared. They wanted to hold cash or cash-like things, and the risk premium, or the compensation you would get for parting with your cash and buying stocks, was very, very high. If you look what happened at assets sort of 2009, 10, 11, is essentially these assets rallied, which means they brought them closer to this line, which offered a huge benefit for those people that owned them in the past and creates a very real challenge going forward for the future. You can get an illustration of that here. This chart, the resolution of it is a little bit difficult to see on the screen, so let me describe what's there. What this is taking is a global 60-40 portfolio. And of course, you guys know from our discussions over the years, 60-40 portfolio, almost all of the risk is concentrated in stocks. So it's basically like being long stocks. The blue line here shows what your average return would be. This is in excess of cash from 1970 now if you take every 10-year period there. So if you run 70 to 80, 71 to 81, 72 to 82, each one of those, on average, what would you get? You get this 4.2% return. This is what's happened over this period of time, this massive return here. And the gray lines here, which barely show up on the resolution, are every 10-year period since 1970. The point, if you look at the return of assets backward looking, particularly stock-like assets, they've literally been off the charts, which is a direct result of the policy that the Fed was pursuing. The key thing is to see now, and what the challenge is for this commission in terms of setting the strategic asset allocation and adding tactical tilts to the portfolio, is whether there's any belief that that will continue going into the future. And from our perspective, we'd bet against it. And this page here, which has got a lot of numbers on it, illustrates why that is. What it's showing you here is, what this blue line here on the chart is showing you is what's gone on with equities over the period preceding the crash and then after it. And you can see that they obviously had a good run here. And then what this table here makes out is what the returns were of equities over these various different periods. They were going up about 9% a year. This is cash plus the excess return from 80 to 2008. They lost half their value in the financial crisis. They had a massive rally after the financial crisis, another rally but not as strong, and then since 2014 they've basically been flat. What are the underlying drivers there? Well, what this is breaking out here, this first set of numbers here is the change in earnings per share. The second is price earnings. And that corresponds to what you see on the bottom here. The red line is earnings per share, and the green line here is PEs. What's the point? The first period of recovery from 2009 to 2011 was driven by a huge expanse in earnings, particularly relative to what people expected. That's why stocks did so well. Then from 2012 to 13, it was basically driven by an expansion of PEs. Since that time, if you look at the last period of time, roughly the last 2 years, you've seen real no change in earnings, which makes sense because the Fed has stopped pumping this money into the economy and credit growth is still relatively weak. And a little bit of a rise in PE, it's overall left stocks flat. What's the big point of this if you step back? We went through a credit collapse. The Fed responded and saved the day, helped the economy, helped assets. But now we've reached the point where the economy is strong enough that the Fed is pulling back on that liquidity. And you face an economy where you've seen this unbelievable run, particularly in U.S. equities. And the question is, what are the most reasonable choices for this commission going forward, knowing what you know about current circumstances? If you look at the expected return of assets here, I think, warning relative to the darkness versus the sunlight, this is probably the most depressing chart in the whole presentation, but it's an important chart. What this is showing you here is what our expected real return is on a portfolio of U.S. stocks and bonds going forward relative to history. And what you can see here is our expected return about it is about 1% real a year, which is a fraction of where it was in the past. How do we get to such low numbers? All we're doing is we're taking the return on cash, which you know. You can just open a Bloomberg machine and see what it's expected to be, strip out the expected rate of inflation. We're taking the return of 10-year bonds, which is also known, and then we're taking the expected return of equities, which is a little bit more complicated, but we use that analysis we showed you on the previous page about where PEs are and where earnings are relative to history, and put that together into this estimate. This is less an opinion about what's going to happen in the future than just the mechanical physics of how assets price. Once you've lowered rates to zero, and you've seen this big purchase of assets, that's over. That's in the past. Now we all have to live with this. And the living with it in a very mechanical sense means that most investors over the next 10 years, we think, are probably going to face the lowest returns on average from a beta only or strategic asset allocation than they've experienced in their lifetimes. So then the practical question is, what do you do about it? Which I'm going to turn to in a moment. This whole situation is made that much more delicate by the fact that central banks can't help you going forward the same way they've been able to in the past. Ever since, I think, probably maybe Volcker, maybe Alan Greenspan, people have had a notion that whoever's running the central bank is a very powerful person. In some sense, they are very powerful. But the power really just comes from a simple lever that they have, which is to lower interest rates and stimulate credit growth. But if interest rates are already at zero, the power of that lever is diminished almost to being ineffective. What this chart shows right here is our measure of what we describe as fuel in the tank. What is the ability of central banks to stimulate the economy relative to history? A lot of people are worried about the Fed tightening. We're not that worried about them tightening. What we're worried about is if the economy turns down, do they have the ability to ease? And if you look at this chart goes all the way back to World War I. We'd say global, developed world central banks are the most constrained in their ability to bail out the economy and bail out markets than they've been ever. So this is where we find ourselves. Now the question is, what do we do next? So I want to turn to South Carolina's portfolio, but let me pause for a second on the environment. Any questions about what's going on in the world or what I've said so far? Sure.
You dealt with the central bank's role in this whole thing, which is largely a function of monetary policy. But you said nothing about the ability of the role of fiscal policies that could, in essence, act as a stimulant. Can you comment on that?
Sure. You're absolutely right that fiscal spending could be stimulative. And I think it's probably the next step you're going to get in the progression of stimulus that you've seen. In other words, if step one is lower interest rates and step two is buy assets, what does step three begin to look like? You've seen some of this. There's negative interest rates. People try to devalue their currency. And fiscal spending is probably part of that. The most important thing about it is the mechanics of how it works. If you lower interest rates, you're targeting spenders. Somebody borrows money and spends on a car that they otherwise wouldn't have. If you buy assets, you're targeting savers, basically you guys. It's a less effective way of stimulating the economy. Fiscal spending gets money directly into the economy. It targets spenders. The government could issue bonds to do an infrastructure project to upgrade our airports. The Fed could buy those bonds. That would be giving money, cash directly to the federal government, which would then spend in the economy. The big challenge with it mechanically is political approval. There's a lot of opposition to any increase in government spending in most countries in the world with elected government. Doesn't matter whether it's Japan or Europe or the United States, there's a lot of opposition to that. And so our concern is with relying on fiscal spending to work is that it may take a crisis to get people to agree to use that tool. And by crisis, I mean higher unemployment. Doesn't seem like we're at that stage right now in the US, so it's a possible tool that they could use, but I think one that would take a while to be used. The monetary policy can be turned on or off quickly. The fiscal policy takes a lot of coordination. Any other questions about the economy or what's going on in the world? Okay. Let me turn a little bit to South Carolina's portfolio. This is sort of a schematic of what the typical institution faces going forward and what they've enjoyed in the past. If you think about the return, the typical institutional portfolio has earned about 9% a year going back to 1970, well above what South Carolina's target return would be. But of course, if you break down what the nature of that return is, 5% of it's come from cash and only 3.6% has come from the asset allocation. I put question marks here on the tactical because, as we'll talk about a little bit more depth soon, of course, tactical is zero sum in aggregate. If I buy, you sell, only one of us can be right. So while you guys have had a pretty good record of adding tactical views to your portfolio for the aggregate, I just sort of put a question mark there. What does this mean in plain English going forward? It basically means if most people rely on their strategic asset allocation going forward the way they have in the past, they're going to be earning something like 4% nominal a year, which is a fraction what people are expecting to earn going forward. So the question becomes basically, what's the plan? So to help sort of come up with a plan, I just sketched out in not a lot of detail what your portfolio looks like to us. This may not be precisely correct because I know you guys are making adjustments to your portfolio over time. This is something we got from the website, but I think in a by and large way, it's roughly representative. You're facing the same cash rate as everybody else. These are your assets here in capital space, and then we tried to break them out here between the strategic asset allocation and what the tactical contributions are. And what you can see here is based on our analysis, we estimate that this portfolio will make about 5% a year over the next 10 years as it's currently constructed. It's a problem. What would we do about this? Well, I'd take you back to the same conversations we were having. I believe it was in, I think Alan was there in Panopolis, right? Is that where we were for the offsite there? About what are the moving pieces that you have under your control. There's the strategic side of it here and the tactical. In terms of this right here, questions I'd have is there more diversification that you could get on this part here? And in terms of the tactical views, this is a very small part of your portfolio overall, and it is enormously valuable in this type of environment to be able to add this type of return stream to your portfolio, particularly if it's lowly related to everything that's going on in your tactical asset allocation. This is a framework we use internally to address these types of challenges, and some of these frameworks I showed you previously, total return, risk rate, plus beta, plus alpha, I've shared with you before. I think this one is new and I hope useful. Whenever we think about what we're trying to do internally at Bridgewater, we map out this question of what's the goal. For you guys, the goal is relatively straightforward. And then we ask ourselves, basically, what is the machine that is going to accomplish that goal? That machine ultimately comes down to the people and the design of the machine. And then what are the outcomes that are measurable from that process? And I always want to be back comparing them to what the goals are. Essentially, the machine by which you achieve your target returns is just the framework that we were just describing. And at the highest level, I think for the commission, the most important questions you could basically be wrestling with is, how can we make our strategic asset allocation the best possible that it can be? And how can we get good tactical or alpha return streams that can be significantly diversifying your portfolio? And it almost, if I were a member of a committee like this, I'd almost be bringing it back to that all the time. How does whatever question we're relating to tie back to the goals and tie the design to the machine to achieve the outcomes we want to get? This is essentially this nature of what's in a portfolio. It is, this is also a little bit like the laws of physics. This is just what you have to work with. There's really nothing outside of this that you could use to try to help you achieve your goal. The reason we break it out so fundamentally in terms of beta and alpha is because the nature of these return streams are fundamentally different. I always think of beta or strategic asset allocation. It's the return you get for renting out your money. You'll get a low positive return from that over time, but there's only so many assets you can use to achieve that return. I would be particularly interested right now, if I were in your shoes, at looking at assets that could potentially help hedge you from inflation. Inflation is discounted in the financial markets. We can look at some of the discounting in a moment, but to be less than 2% over the next 10 years, closer to 1.5% over the next 10 years. Mechanically, what that means for the pricing of assets is that if the Fed is able to engineer inflation higher than 1.5% over the next 10 years, that's going to be a shock to the price that's embedded in the assets that most people hold. It's going to be a shock to nominal bonds. It's going to be a shock to equities. And the question I would ask is does the portfolio have enough balance in that regards? And then in terms of the alpha, these are, by definition, they're deviations from the strategic asset allocation. It's very hard to generate alpha return streams over time. But as you can see from these previous pages, there's no way, just in terms of the physics that come out of the low cash rate for South Carolina to meet its target returns without having alpha. So if you have the ability to access good alpha, I would try to squeeze that for all I can to help anchor back to what the overall goal is, which is to meet the expected return for your beneficiaries. I don't think there's any easy choice going forward from here. You're in this environment, again, as challenging as what we saw in the 1930s. The cash rates are locked in. You only have the levers of beta and alpha. From here, essentially, I would say the commission at the highest level needs to pick its risk. You could accept lower returns. People are just going to have to work longer or live on less. You could accept bigger drawdowns, just take more risk in the portfolio. If you take more risk, when markets turn down, it's going to be more painful. You could bet on a single asset class. You could bet on stocks. Stocks have done well. Maybe that's the bet you want to make going forward. From our perspective, and you guys know us well at this point, the two big things that we would do is A, emphasize diversification. Doing so is going to create peer risk. It'll pay off over the longer term in terms of your return, but it'll generate peer risk. How do you weigh those two things? We can't answer that for you, but that's the issue that you're going to face. And we would really emphasize alpha as well. The common household investor basically can't get alpha or tactical skill in their portfolio. It's too rare. So for my friends that ask me, Paul, you're a money manager, what should I do with my money? I'd say stick to index funds. But for an institution like you guys, you have access to the managers that other people don't. It could make a huge difference. So can you make a study of your alpha choices over time? How good have those been? Could you get more from that? That also creates risk. It's politically sensitive. Beta is cheap. Alpha is more expensive. It can work out for you over the long time, but how do you navigate those trade-offs? So essentially, our message to you is, listen, we are honored to have a long-term relationship like this. This is what came here and talked to you in 2006. This is what I was hoping could happen over years. We just continue this dialogue. We've tried to be a good return stream for you. In terms of the environment, you're simply facing a very challenging environment. Now the choice is, what are the most reasonable choices we can make to try to improve our odds of getting through this over time? And we always find, going back to this framework here, what's the machine? How does the machine work? And probabilistically design your effort to give you the highest possible odds of meeting your goals is how we'd proceed forward. Questions or comments?
Well, is that, in your judgment, is that 60/40 formula still valid? In terms, I mean, from your previous slide, it would look like historically that's obviously worked. But going forward, will that continue to work, or are we going to have to adjust that?
Depends a little bit how you define the term work. Do I think that there will be a positive return relative to cash of holding a 60/40 portfolio? Yes. Why do I say that? I say that because of this framework right here. Literally, for a capitalist system to function, you have to have assets have a higher return than cash. If people really began believing that cash was going to have a higher return than assets, people would sell their stocks and bonds. You would get a collapse in the stock market, which would hurt the economy. So policymakers are very incented to use monetary and fiscal policy to keep assets attractive relative to cash. In that sense, it'll work. However, will you get returns like this here that you've had over this recent period of time? The 75th percentile from the range of these returns here is 5.2%. You're in something like the 90th percentile in terms of the returns since 2008 of the return of the 60/40 portfolio. I wouldn't bet on that. And it's a challenge because looking backward, that was the obvious thing to do. The question is, what's the most reasonable bet to take going forward? If you look at, I'll show you a chart here that's in the appendix that I think is interesting. If you look at, this is showing you, all weather is a more balanced mix, and put aside all weather. If you guys don't want to do all weather, take your money back at all weather, but the principles behind all weather are the principles I'd be thinking about in terms of your strategic asset allocation. If you look at the return, this is all weather minus 60/40. All weather is basically just more diversified than the 60/40. And this shows you what the gap is in return over rolling 1 year, 3 year, 5 year, 10 year, 20 year, and 30 year returns. Why do I have this here in the appendix? Because the return of one portfolio to another in a 1 year period or even a 3 year period is almost 50/50. The benefits of diversification become more apparent the longer the time frame. As investors, we should be thinking in terms of 5 and 10 year time frames. It's hard to do, though, particularly with iPhones and things like that. Everybody's attracted to what happened most recently, which is basically this perspective right here. So I'm giving a long-winded answer to your question. Do I think the 60/40 will help relative to cash? Sure. Is it the best asset allocation? From a strategic standpoint, I'd say no. And I think the evidence is that from here, what happens in assets is just going to be a function of what type of economic growth and inflation we get relative to what's priced into those assets today. What's priced in right now is relatively strong earnings growth, in the case of the United States, and extremely low inflation. Meaning, for you to get another upside surprise from here, inflation would have to come in even lower than it's discounted to be. And that could happen. If we get Japan and the United States, that'll happen. But I wouldn't be betting on that as my starting point in terms of my strategic asset allocation. I'd be betting on a more balanced asset allocation if it was, if it was Bridgewater basically making the decision. Does that help?
Yeah, I guess the other question I would have in terms of generating alpha, you listed a number of things that we could do options that we would have. Given the historical returns of equities over, say, from the often quoted 7 to 8% annual rate of return from 1928 to the present, of the options that we would have in generating alpha, does that historical return should it tilt us towards a heavier allocation to equities?
It all depends on your goal. All depends on your goal. In terms of the historical return of equities, the reason why they've had the 7 to 8% is because the cash rates have been high. The actual excess return of equities, once you strip out the cash rates, basically once you strip out this average cash rate here, is only about 3.5%, not 7 or 8%. So once the cash rates have come down in a very mechanical sense, you know that the equity return is going to come down too, which is, by the way, what you've begun to experience here more recently. These types of low returns here that you're getting from equities completely consistent with what you would expect once cash rates come down. So first point I'd say is the expected return of equities in the United States or globally over the next 10 years is probably about, if you take these cash rates here, say you're going to get about 1% there, you're going to get about 3.5% there, it's probably closer to 4.5%. Point one. Point two is, when I say it's all about your goal, it all depends how you want to structure the alpha. If your goal is to get the highest return you can get for the risk you're taking, there's no need to necessarily have equities be part of your alpha. If your goal is to outperform equities, then absolutely you would want to make equities part of your alpha. And then what I'd recommend doing is basically have your strategic asset allocation. You could make that a 60-40, and then you could put the equities on top of it in an overlay structure. And that could be very useful for achieving your goals, but it all depends on what that fundamental goal is. Does that answer your question?
Yeah. Could you also comment on, the discussion and that's really centered around, because of this low interest rate environment that we're in and are likely to continue to be, the role of dividend, high quality dividend paying stocks in the equity universe.
Sure.
Is that a segment within equities that could further help us?
I would describe that, the idea that high-quality dividend-paying stocks are going to help you, that's essentially a tactical view on the pricing of those stocks relative to, say, stocks that are related to solar energy or electric cars or whatever other thing could shift. In other words, the fact that they've been paying higher dividends in the past is well known to investors. That's in their price, and they've been priced appropriately. From here, the performance of those stocks relative to other stocks is literally going to be a function of what happens in the economy relative to what's priced into them already. If we get a period of weaker than economic growth because of whatever shock, China or what goes on in Europe, those dividend-paying stocks could be a terrible deal. If we get more of the type of environment that we've been in more recently, they could be a great deal. So I would describe stock selection, which stocks you want to hold, as opposed to I want to hold a basket of stocks. The which stocks you want to hold is a tactical view. The basically saying I want to hold stocks as part of my strategic asset allocation here, I'd say that is basically strategic. So in that question, it basically comes down to your expertise in being able to discern between one stock relative to another against everybody else in the market who is looking at that same pricing difference. I don't know. Yeah, go ahead.
Well, I guess just one further point. What from what you're saying, obviously, you have some degree of skepticism. However, what degree of importance do you place on the kinds of high-quality dividend-paying stocks that have not paid dividends and increased their dividends over not just a relatively short period of time, but over extraordinarily long periods of time? I mean, there are examples of high-quality dividend stocks that have paid and increased their dividends significantly over 50, 60-year periods.
Right. And that's a very reliable asset, and I would say that that's baked into the price of that asset already, because, of course, everybody would value a cash stream like that, so the price of that will be bid up, meaning that the potential for you to lose on the capital you're invested on that becomes higher, because if there were to be any shift in the economy, say that the Fed, to deal with this very high level of debt here, begins to, just put this out hypothetically, begins to tolerate a higher level of inflation than they have historically. They've got a 2% inflation target. They've missed their 2% inflation target over a protracted period of time. So what is the potential for them now to be very easy in raising rates, let the wage pressure come through, begin to get higher nominal wage growth, to be able to increase wages relative to the stock of debt, to allow people to pay it down? That's an environment that we haven't been in since the 1970s, basically. What I would ask is I don't know, but the questions I would be asking if I were examining that question is, how safe are those dividends if you begin to get a higher inflation environment? I don't know. But those are the types of questions you have to ask on that once you get into the realm of tactical views. I would be, if it were for my money, I would be more in the camp of, with the strategic asset allocation, you already have a ton of equities here, whether they're dividend or non-dividend paying stocks. You got a lot of assets that are very dependent on the economy being relatively healthy with low inflation. I would be interested in getting assets that are diversifying relative to that. So as opposed to getting a high dividend paying stock, I would be more interested in buying something like an inflation-linked bond. Nobody, I go to these commission meetings all over, nobody, lots of people ask me, which stock do you want to buy? Nobody asks me about whether you'd want to include inflation-linked bonds in your portfolio. It's got to be one of the most hated assets in the world right now. Why would you ever buy anything with such a low real yield? And the answer would be, because it would be diversifying to this if we were to get inflation. Sorry.
What if the inflation, because of the formula on the inflation-linked bond is misstated, right? I mean, everybody knows the inflation is in healthcare, and healthcare has a 17% weight, and housing has a 41% weight, so why do I want to link to CPI, right? When arguably I could find a asset that better reflects where the inflation actually is going to occur, because inflation occurs where government spends its money, and government spending its money on healthcare, right? That would be the argument against that. The TIPS have a structural problem to them, I think, would be the argument. That there are better ways to express that same view, right?
You could, we've looked at different ways of, so two parts of the argument. First thing I would say is, if you get to the design of South Carolina's machine, broadly, do you think you have enough inflation hedging assets, and do you think you have enough alpha? That would be the first question I'd ask, a yes or a no. I don't know the answer to that. I don't know if the commission knows the answer to that. Then if you answer that question in the affirmative, yes, we would like to have more assets that are going to be diversifying relative to the equities if inflation comes in higher than expected. Then you get into an implementation question of, how do I best do that? It's something we spent a lot of research on. We're happy to have that. If you want to have us come back and talk about how we do that, we'd be happy to have it do that. There's parts of your argument that resonate with me, parts that don't. I'm worried if we get into all the details of that all of a sudden you and I might be having a lot of fun, but I think the rest of the people might get really irritated with me. So the big thing I would be thinking about is, you got a lot of this, are you comfortable with that? And do you feel comfortable that the equities would do well if we get inflation higher than expected? I'm not saying we are going to get inflation higher than expected. All I'm saying is, if you just think about the physics of how assets price, the assets that you hold right now are discounting in that price 1.6% inflation for the next 10 years.
That's actually what I was trying to ask was about inflation shock. So,
Yep.
Obviously TIPS comes up all the time, but could you just speak to what you think are the most effective assets to hedge against inflation shocks? So I guess maybe expanding a little bit on Alan's
Sure.
question as well, because, the classical financial theory will tell you that over the long term, stocks are inflation hedges, real estate, things that, but what really serves as an effective hedge in a shock environment, and can you have enough of it without levering the portfolio to truly protect? So as consultants, we always struggle with this inflation discussion. Everyone's interested in it, but then they start looking at the expected return implications of having a lot in these asset classes, and they start to put less weight on that inflation shock scenario because it's a distasteful expected return impact unless you lever the assets.
Yep.
So I just wanted to hear your thoughts on that
Sure,
topic.
be happy to. The short answer is, from our research, the best thing is a mixture of commodities and inflation-linked bonds. Now, let me explain the logic why. First, on the equity piece of it. At first glance, you would think, listen, equity is sort of like a real asset. I own a company. They're selling stuff. As the price of the stuff goes up, they can increase their prices. I'm protected as an investor. Turns out, if you look at it, it doesn't work that way for two reasons. First thing is that as inflation goes up, investors won't hold bonds at the same price. There's a squeeze going on in the U.S. bond market, global bond markets right now. Yields, as you guys probably know, Japanese and German bonds, 0 or negative. So people are rushing into U.S. bonds. Those yields are very low right now. If we start printing inflation that's at 2 or 3 or 4%, people will not hold those bonds because it wouldn't make any sense. As they sell those bonds, the yields will go up. And as the yields on those bonds go up, price-earnings ratios go down. That just very mechanically changes the pricing of the stocks, because all of a sudden, if you could get much higher 30-year guaranteed government yields, you're not going to hold them. But if you look at the performance of stocks when inflation begins to rise, it doesn't look good. Moreover, while the company can change the pricing on its goods, as inflation goes up, it's actually difficult for them to figure out how. Because how much do they raise prices relative to the other person's? Is it needed to their market share? And what you see is margins at companies begin to shrink in that situation because they tend to be cautious about doing that. And so what you see is that equities in an inflationary environment, a little bit of inflation, probably not a big deal. But in a higher inflation environment, they're terrible investments. And if you want to look when people really get wiped out, look at the bear market in equities from 68 to 82. Not a good situation. In terms of what Alan is talking about in terms of trying to hedge different pockets of inflation using things like healthcare stocks, et cetera, we've looked at that. The trick is that there's a lot going on in a healthcare company beyond just the pricing. They've got their own cost base, what their debt structure is. So there are all sorts of moving parts of the equity beyond the price of the healthcare thing. So we actually had some unions that have healthcare plans that asked us to help hedge their healthcare costs. Turns out to be a very difficult thing to do. So first point is most investors have got a lot of this. They don't have things that are diversifying. Second point is, as far as we can tell, based on the evidence and the logic, equities aren't great. So then you're dealing with, what are my least worst options here? And that's where we get down to, if you think about, does CPI miss certain parts of inflation? You bet. No economic data, though, is accurate. You think unemployment captures the amount of people that are working under the table? You think the productivity measures the amount of stuff that you can do for free, like Google searches that aren't picked up in a productivity search? No way. No economic data is 100% accurate. If you think about literally what you're paying for, your purchasing power getting eroded, there's basically two things that do it. The first thing is the cost of getting stuff to you, or you getting someplace, goes up. That's basically raw materials. Think about driving your car, heating your house, or the vegetables and fruits you get at the store. That all has to be brought there. It's basically raw materials. And the cost of people producing it. It's basically raw materials and wages. And so we try to find the best hedges we can for that. That's basically how we go about it. Yeah.
Just a question on a particular product, right? risk parity, I know like during the crisis, y'all sort of made the objective thing to change the risk profile, but with so many global bonds negatives, are y'all doing that now? I mean, what, that's a structural problem. Like, because I know
Right.
like nominal bonds are obviously one of the buckets.
Yep. Right. There's. I just want to make sure everybody, because I know some people know us really well, some people know us less well. Alan's question, make sure it makes sense. So of the two strategies for you, we got the all weather, and then we got the pure alpha. The all weather we think of as an overall metric for South Carolina's asset allocation. And the way we do that is we have 4 different, I don't actually have a chart of it here, but we have 4 different sub-portfolios within all weather. One portfolio that does well when growth is stronger than expected, one when growth is weaker than expected, one when inflation is higher than expected, one when inflation is lower than expected. You may have seen that in some of our documents. We use nominal government bonds to protect us in an environment where growth is weaker than expected. And Alan's question basically is, wait a minute, if Japanese bonds are trading at 0, do you really want them in your asset allocation? And our answer to that is no. So when the yields on those government bonds get too low, we take them out of the asset allocation or replace them with a bond that has a yield that we think that can protect us. So over the years, we've been managing money for you. We've taken Japanese bonds out, we've taken German bonds out, and replaced those with U.S. bonds. The big picture that we're trying to do is, if you think of the traditional portfolio, this is showing the attribution of returns going back to 1970. What we're trying to do in an all-weather style asset allocation is just spread the risk. So here are nominal bonds. They don't play a dominant role, but they've played a role in the return. Of terrible in the 1970s, just like what you would expect. They've been good more recently. What's going to be the best performing asset class over the next 10, 20 years? I have no idea. None. And I don't think anybody knows. So then the question is given that, what do you do? Other question. I want to be very sensitive with our time too. I know you have a busy. We're at your disposal. We got nowhere to be. I enjoy talking with you guys. So
We spent a lot of time in the U.S. Can you talk about outside the U.S., specifically Europe and emerging markets and implications there for what you're seeing
Right.
for equities and other assets?
So as a starting point in terms of our, building a portfolio here, we've been focusing mostly on this. And our starting point with building a strategic asset allocation, just hold a lot of everything. It's going to make money over time. That's sort of, you can see that, we've been talking about the same thing for 10 years. This is basically, it makes money over time. It's just a long portfolio of assets. Now if we turn to the tactical view, what do we see there? That's interesting. Well, we think that there are a lot of excellent opportunities outside the U.S. In fact, we'd say more outside the U.S. right now than inside the U.S. Why? Well, because the Fed put its foot to the gas, drove money into the asset markets here, and our asset markets have become a little bit rich. Other people are behind us in that. So I think Europe is an interesting case. It's always a lot of fun in the United States to make fun of Europe of basically being wildly unproductive and people working 35-hour work weeks and stuff like that. We understand all that as well. It's also true there that the economic machine in Europe works the same way as the economic machine here. There's income and borrowing. What happened in Europe was that they were behind what happened in the U.S. They had an implosion. Due to too much credit, we had an implosion. The difference was the European Central Bank did not stimulate with the speed that the Fed did. Now that they've begun to do so, we actually see signs of improvement in Europe. Draghi, the guy running the European Central Bank, is hated by a lot of people in Europe the same way that there was a lot of anti-Fed criticism here in the United States. But a little bit like with your asset allocation, there are no easy choices. You have to take your least worst choice. That's the same way we look at what's going on in the European Central Bank. We see them doing the right thing. You're beginning to get unemployment down. You're beginning to get improvements in some of those economies that have made structural reforms, like Spain. And so we actually think that stocks are attractive in Europe. If you look at Japan, same type of thing going on there. They have been in a long period of low growth and deflation, and we see Japan really trying to work hard to improve, and we think that their equities are actually attractively valued relative to U.S. equities. And if you think about emerging markets, the whole period of time that the U.S. was doing relatively well, emerging markets were at a real crisis. The combination of particularly China going from a high growth to more of a low growth environment and commodity markets rolling over wreaked havoc on a lot of emerging markets. Think about a place like Brazil, very dependent on commodities, or Russia. And those economies now we feel like have stabilized, and we feel like there's some attractive opportunities there, particularly with regards to the currencies. So on the tactical views side of it, I think that there's a lot of interesting places to be right now in the world to try to extract value, but it just requires, at least for when we approach it, it requires a ton of research to be able to find those opportunities and scale them appropriately so that we can have high conviction bets in the portfolio, but don't get too concentrated in any one area in case we're wrong.
Implications for the dollar move from, I guess, it's no longer recent, on competitiveness of both the U.S. and the countries around the other side of the dollar strengthening.
Yep, the dollar, really just because the Fed was tighter than other central banks, the dollar responded pretty much as you would expect it to be. The Fed had its foot on the gas, but then as the U.S. economy began to improve, it gradually took its foot off the gas, and that taking the foot off the gas effectively just reduced the amount of dollars they were printing at the same time that the European Central Bank and the Bank of Japan were printing currency like crazy. And so you saw flip the currency went up. Remember, the euro was trading, for those people who follow currency markets, sort of like at a 140 range, and fell down a lot. It's hurt U.S. competitiveness in exactly the way you would expect it to. Particularly in the United States trade of non-commodities. You've seen that those sales begin to go down. So it's hurt us, and that's a little bit of a break on growth. On the other hand, the U.S. has had this energy boom here, and even though energy prices went up and down, and now they've gone up, the demand of the U.S. for foreign energy is really at an all-time low right now. So it has softened the impact on the U.S. economy due to the dollar going up that you normally would have seen. So I think that the outlook for, if you sort of turn to the global economy, we think that the outlook for the U.S. economy is boring, positive growth. Europe is pretty much the same thing. Japan is pretty much the same thing. We think China is going to grow okay, just not nearly as fast as it had. Some of the big tactical opportunities are the fact that the markets are priced right now as if we're going to go into a global depression. And we think that that's unlikely to happen. So tactical opportunities that benefit from that, certain bond markets in the world, we've sold those bond markets on your behalf with the expectation that the yields will go up because we think the expectations in certain bond markets are too pessimistic.
Well, from what you're saying, would I be right to conclude then that everything you've said would indicate that the best course of action is to maintain a well-diversified portfolio and not try to get too cute about trying to pick the winners and losers?
Well-diversified portfolio, and then this contribution to your total portfolio is very small. This is where I'd do the well-diversified portfolio here. And then here, I would look to see if you could add some of that to your portfolio. If, again, it depends on the goal. If the goal is to get a higher target return, I would pull this lever here. If the goal is to minimize pure risk or pay the smallest amount of fees as possible, I wouldn't necessarily go after that. But if the goal is to hit this return, I would diversify here. You got 30 basis points by our estimate. You've got 30 basis points of return from the total plan level from all of your tactical shifts. It's not that much. There is frameworks and research we've done with certain clients, and again, we want to be a good strategic partner. If it's useful, we can go down this path. If it's not, it's not. There are frameworks and templates we've used with certain clients to help them select other tactical managers. Not us. We're not asking for more money. I'm saying that to help you do this well, we could share with you some of the techniques we've helped share with other people, if it's helpful to you. So I'd do both.
One other thing, there's the fact that we have a yield advantage in the United States, and the fact that we've had an instability in many parts of the world has caused an inflow of funds and investment into the United States. How significant is that in terms of giving the U.S. an advantage versus other markets, and how long do you think that's likely to continue?
I'd be worried about betting on it. It probably has helped, but I'd be worried about betting on it continuing. Some of the turbulence that you saw in global markets, equity markets are down for the year, or they're flat in the U.S., but many foreign markets, they're down massive amounts, is related to a pullback in that capital. So a lot of that money that's flowed into the United States that you're referring to has come from sovereign wealth funds, particularly in the Middle East and Asia. The Middle East sovereign wealth funds, as oil prices went up close to $150 a barrel, they had money pouring into them, which they then put in an asset allocation not that different than yours, which required them to buy a lot of U.S. assets. As oil prices collapsed and then bounced to $50, you've seen those people come under acute funding strains. You've also begun to see problems with Asian companies, China most notably, trying to stabilize their exchange rate. The net of that has meant that they've had to sell a lot of assets, particularly out of the U.S., to do that. And so that's been outflows of capital out. And the merits to me of having this be diversified is that that could happen again. And then the merits of having this in the portfolio to me is I would think that if I were in your shoes, I would want managers who have an understanding about how that money is going to flow around in the future as opposed to how it's moved in the past to help me negotiate that environment.
I guess the thing that you have to wrestle with is the fact that you take a place like China, which, even at 4 or 5% growth would be very desirable in almost anywhere, but it's down from 7 or 8.
Right.
The point of the matter is, we know that there's been continues to be a significant outflow of capital out of China.
Correct.
Largely to the U.S. And other places. But the point of the matter is, does that tell you something about what capital in China views of their own country, number one? And I guess the thing is, we know that in large segments of the real estate area in the United States have been fueled largely by money from China, even Russia. I mean, the point of the matter is that these are countries that have experienced and are continuing to experience significant capital outflows.
Yep.
To our benefit.
Yep.
Now, we can speculate how much longer that will continue. You seem to feel that may diminish here in the relatively near future.
The way I think about a case like China is essentially the Chinese, everybody needs, they need more of this. The Chinese want to have more U.S. assets. But it's also true that U.S. people don't have enough Chinese assets. And so that capital outflow question is going to be a function of how much money flows there relative to how much money flows here. I'll give you an interesting example. Alan was talking about government bond markets all over the world being at a yield of almost 0. Government bonds may be boring, but they're useful in an asset allocation. Do you know that China has the second biggest corporate bond market in the world? And it has the third biggest government bond market. And those markets are closed right now. South Carolina couldn't easily put them in their asset allocation. About 2 months ago, the central bank there announced that they want to open those markets up precisely to balance the flows that you're talking about. They're getting outflows out. They want to attract inflows in so that they balance. They don't have pressure on their exchange rate. So that's going to be a huge structural shift in the world. Typically, when you see an emerging market open its bond market, it's a tiny thing. Like if Bolivia opens its bond market, South Carolina doesn't care about it that much. If China does it, it would be a big deal for you. Why? Because it could help you a lot in your diversification, and if you have managers that can trade those markets, it could help you in your alpha too. So I hear you in terms of those outflows having made a big force in markets, and the only point I would add to the conversation is that going forward, you can continue to get huge shifts in asset markets, depending on what the global opportunities are. And in terms of your asset allocation, I would assume that South Carolina can't predict those. Just go in terms of diversification. And in terms of the tactical shifts, I'd make sure you have managers there that you feel like have a handle on those things to help add value. We good?
Anybody else? Questions, comments?
Thanks again for having us in, and again, we just, tell us how we can help, how we can be of service, and we'll do whatever is useful.
Are we all through with these guys?
Yeah, we're all through Bridgewater, yes.
Yeah.
Yeah.
Thank you very much.
Sure, my pleasure.
Thank you very much. Thanks.
Well, it wasn't as dark and gloomy as I thought it was gonna be. That comes down to the point, like, they're the smartest guys in the room, telling us they don't know what's gonna happen, so, this whole diversification thing, that's really what we have to do.
Do you think we can do this 5-minute break or something? Are we going back, or do we have?
That's y'all's call. Do you want to do it, or do you think we've got enough?
You wanna have maybe just a very short discussion, give people, or what do you think?
I'm gonna take a break.
Oh,
yeah,
we
definitely
can
take a break, yeah,
But
yeah.
do you still wanna have a short discussion on the self-evaluation?
I see.
I think it's.
That's the only way I've left.
Yeah, I think we should.
Yeah,
Okay, fine.
it can be brief.
Sure, okay. All right, well, you want to announce it, we'll take a.
Okay, 5-minute break. Let's see, we're in, now, are we in?
We need a motion to go
Are we
into
in public session? prior
No,
to-
we're still in public, yes, sir.
Okay.
But we need a motion to go into executive session to discuss
Do we need,
personnel matters.
okay, let's have a motion to go into executive session?
I move that we go into executive session pursuant to SC code, whatever.
It's
whatever.
section 30-4 at SEEK.
So we need to excuse you
discuss personnel
folks.
matters. We're, we'll have, not now, no, yeah.
All right, let's see, we need,
And this is probably, of course, this is probably like the last thing that we're gonna do.
okay, let's see, we have a motion to go into executive session, second? Second, okay, all in favor, aye? Okay, we'll now go into executive session.
All right. No action was taken during executive session.
All right, so if there is no other further business to come before the commission,
I move that we adjourn.
second?
Second.
All in favor? Aye.
Aye.
All right, we are
All
adjourned.
right, thank you.
All right, Michael, thank you.
Thank you.
Okay.